Folks, welcome and good morning. Thank you for coming to our webinar hosted by Sunbelt with our guest speaker, Jizu of PP&Co. And the webinar is regarding small business tax planning. My name is JC Meyer. I'm the operations manager for Sunbelt Business Advisors here in the Silicon Valley. And we are going to do a format of 45 minutes to 50 minutes of presentation from Z. And then the last 10 or 15 minutes we'll open up for answering any questions you might have. If during the presentation you have any questions at all that arise, please feel free to type them into the Q&A box. If it's a really good question, we may answer it during the presentation, but more than likely we will answer all questions if we can at the end of the webinar. So please, again, feel free to send the question over through that Q&A box at any time during the presentation. And with that, I will turn the presentation over to Helen Liu, the broker and owner of our office.
Okay, thank you, JC. Good morning, everyone. I'm Helen Liu, the principal broker of Sunbelt Business Advisors in Santa Clara County. And Sunbelt has the largest business brokerage network in the world. Our office has been serving the San Francisco Bay Area for over 20 years. Every month or so, we try to put up a webinar like this that is informational and interesting to our clients. So today's topic is on tax planning, and it is our honor to have Ms. Jie Zhu, partner of PP&Co, to give us a presentation. Jie has been a practicing CPA with PP&Co for over 20 years, and she's also the chair of PP&Co's International Department and Education Committee. And Jie also serves on many local professional and community organizations as mentor and director to promote good business practice and community alliance. So notably in 2019, Jie was awarded as one of the Women of Influence by Silicon Valley Business Journal. So without further ado, let's welcome Jie.
Thank you. First of all, this is a good picture of my partners, and it's not a current picture because we have recently promoted 4 more partners, and so we have a group of 12 now. But because of the pandemic, we haven't been able to put together a take a group picture. So this is one of the older pictures, and our firm was founded in 1951, has been around for almost 70 years. All right, so today we are going to talk about some of the tax planning strategies for small businesses, and we're going to cover 4 major sessions during this presentation. The first one is entity selection, and then we're going to cover some of the PPP loan forgiveness update, the year-end planning strategies, and certain capital gain deferral strategies in regards of setting of your business. Okay, so the first session, entity selection. There are 4 major types that taxpayers use or entrepreneurs use. And we're going to go through the session pretty quickly because I assume that most of you have already gone through this process with your attorneys and CPAs in the past when setting up them. But certain types will impact, how we are planning for the future when it comes to M&A transactions. And so that's why I want to touch, quickly on the session. The first one is C corporation, and in the past, the C corporation was not one of the attractive, most attractive entity type for small businesses because of the pretty high corporate tax. But the 2017 tax law changed the rate of the C Corp return, C Corp to 21% flat tax rate. So that has been more attractive, but yet, even though it's 21% flat rate, it's pretty low, C Corp remain to be subject to double taxation. What that means is when you have a C corporation, that the corporate will pay for income tax on its profit. And then when the C Corp distribute dividends, then the shareholders will need to pay tax on dividends as well. Or when the shareholders sell the C corporation, stocks that they normally will need to pick up the capital gain tax as well. We'll talk about some planning strategies around the capital gain later on involving C corporation. The second is S corporation. S corporation, the good thing is there's no federal level tax, and on state side, if it's a California C corporation, then it's a 1.5% California tax on the net profit. Each state may have different rules regarding the C corp taxation, so that need to be, if you're concerned with any specific states, and that should be consulted with local practitioners. C corporation, the income are considered a pass-through, so meaning that the C corp will file a tax return and will present a K1 to the shareholders, and the shareholders will use the K1 to report income on their personal tax returns. So there's only one level of tax, generally speaking. But there are some limitations of S corps, and especially when you are considering bringing in foreign investment. S corps do not allow foreign shareholders. That's one of the major limitations. So that's why a lot of times the tech companies, startup companies do not use S corp because they are not able to involve foreign investment. Partnership is does not have federal and state tax in general, and it's also a pass-through that the income of the partnership will be passed through to the partners, and then they pick up on their personal tax returns. LLC, limited liability companies, is a tricky one. First of all, that if the LLC is located in California, then there's an LLC fee on top of the $800 minimum tax the government charges. The fee is based on gross receipts. So meaning if I have a $2 million of gross receipts, and then I not only paying a $800 minimum tax, I also need to pay a LLC fee based on my receipts. So that can be substantial to some of the small businesses. So that should be taken into consideration when you select a certain type of entities. There are generally two types of LLCs. One is with only one member that is 100% owned by one party. In this case, that this single member LLC have two choices for tax reporting. One is it could stay at its default format, which is a disregarded entity. In this case, all the activities of the LLC will be reported directly on a single member's tax return, as if they're doing the activities directly themselves. The second choice for single member LLC is a corporation. So the single member LLC will be able to file a election to change its status for income tax purposes to a corporation. And then further that it could also make another election, second election, to treat itself as an S corp. So essentially a single member LLC is possible to be taxed as a disregarded entity, to be taxed as a C corp, or be taxed as an S corp. And that's, it has some flexibility there. And the second type of LLC is more is with multiple members. In this case, that the default reporting is that it's treated as a partnership for income tax purposes. Then again, it has option to be treated as a corporation or as a S corp. All right. So we are, before we're getting into the gain deferral, I think, strategies and some other planning strategies, I want to touch quickly on the Paycheck Protection Program, PPP Loan. That has been going on for quite a while. So I assume that a lot of the business owners have dealt with it or have applied for it, and now probably are in the application stage for the loan forgiveness. There are some specific factors that I would like you to consider. And the first one is that if you are currently in the stage that are selling your business or have major ownership change in your business, that you should check with the attorney and with the bank on making sure that ownership change will not generate any issues for the PPP loan. Because a lot of times when we sign up for a loan, the loan documents will contain certain articles or terms regarding loan covenant. And so which, when there are ownership changes, often there are impacts on the loan itself. I believe that there are rules that came out recently regarding this, and generally speaking, the change in ownership should not impact PPP loan. However, please consult with your attorney on that and just make sure. And on the taxation side, again, this is a tricky one. Initially, when the PPP loan came out, and everybody's expectation was that the loan will be forgiven, and the forgiven part will not be subject to tax, and also the expenses that were that were paid by the PPP loan money will be deductible. And because the reason that people have this expectation is the intention of the loan initially was to, really helping business to survive this difficult time. However, the IRS came out with a rule saying that, hey, look, and the loan forgiven that is not taxable. And so that part is in line with what we expected. However, the expenses paid by the PPP loan will not be deductible because your income is not taxable. So you for anything that you paid for a non-taxable income will not considered cannot be deducted essentially. But that's kind of contrary from the intention of the loan initially. So now there are there are certain proposals out there, and it seems like that it's very possible that by the end of the year, certain laws can pass, may not be able to deduct the entire expenses paid by the PPP loan, but for certain smaller loans, I think if I recall correctly, for loans that's under $150,000, and taxpayers may be able to deduct 100% of the expenses, but we'll see. So the proposals are out there, and we're hopeful that something can get passed before the end of the year. If that's the case, that could be great news for a lot of the small business taxpayers. So there are a couple of things that's involved with this. One is, what if that the loans, the expenses are not deductible, right? Or maybe a portion of it is not deductible, especially for the people who took out loans that are higher than the $150,000. Because when we calculate the loan forgiveness, there are different type of expenses that can be used, right? And apparently your wages and salary is the major part of it, and the healthcare expenses, and there are some other retirement contributions could also be one of them. So because of different type of categories of expenses can be used, and as long as I think that you need a standard that 60% of expenses are paid, are used for the wages, then you are eligible for the forgiveness. So there's a little bit, planning that can be done here. So when you apply for the loan forgiveness and just try to use the expenses that's not a wages and for the loan forgiveness, and essentially you're presenting, okay, this is what I use the money for, right? And their salaries, there are other things, and use as many as you're allowed. Use as many of the other type of expenses as you're allowed, and for the application. So this way that you may be able to how do I say that? Later on, save the wages for some other type of deductions later on. And also that has impact on your R&D credit, and is for the R&D credit, I'm not sure what type of business you guys are in, but the R&D credit can be impacting a lot of different industries. And if you are applying for the R&D credit, and now we're saving, as I mentioned, that we're saving some of the salaries, then we are able, because for the R&D credits that the healthcare and the retirement type of expenses that's allowed for the PPP loan are not considered in the R&D credit calculation at all. So this way, if we save some of the salaries and for later for the R&D credit calculation, then we can overall can achieve a better tax result. And also this, this involves timing is what if that we are, our expectation is that the expenses may not be deductible, then should I go ahead to still apply for the loan forgiveness? And our answer at this point is yes, you should. And because the current rule is if you have reasonable expectation that the loan will be forgiven, then that the expenses cannot be deducted. That's the current rule, right? So under this rule, it does not matter if you will eventually be forgiven. If you have reasonable expectation, it will be forgiven, then you cannot deduct it. So essentially that start your application now, and however, extend your income tax return and until the rule kind of settle down or the new rules come out, then when we're certain, have more certain guidance on the deductibility of the expenses, then file the tax return. So instead of like trying to rush through the filing and then you have to come and amend if it turns out that the IRS allows certain deductions but yet you did not, and then they're just create more hassle down the road. So our advice at this point is yes, go ahead and apply for the loan forgiveness and but extend your tax return. Some of the year-end tax planning strategies, and some of them are, I would say that they're not all specific to 2020 or not specific to during this pandemic, like situation. But these are the good strategies that you should consider, and some of them could help you, could cover like multiple years. And the first one is timing of revenue and expenses. Depending on what type of accounting method you're using. If you're on cash, maybe you want to kind of accelerate the payment of expenses and to 2020 and leave the collection maybe to next year if you have control, but sometimes it's out of our control. But it could make a difference in what you're recognizing for 2020 for income tax purposes. If you're on accrual basis and again, that take a look at your revenue and your expenses. Is there anything that you haven't received a invoice from your service provider, but they did perform the services? Make sure you accrue that expense and to so you can take deductions when you do your tax returns. And the timing is also make a I would say a impact when you calculate your net operating loss, and especially with the 2020, a lot of business are seeing that decrease in revenue, and so they are expecting to have much larger net operating loss. The 2017 tax law change that eliminated carryback of the NOLs. However, because of pandemic this year, the CARES Act and allowed carryback of NOL for 5 years. So, but that's only applied to the net operating loss that incurred in 2018 through 2020. So if you have losses that during those 3 years, now you are allowed to bring them back to past years and to claim some of the tax the tax refunds. But that being said, you're allowed to carry back, you're also allowed to carry forward. So you really need to take a look at, okay, what's my tax rate for the 5 years prior, and what's my expected business for future years, and which one will I generate a better tax result if I carry back or carry forward. So there are some planning things that can be done for this, but that's involve certain business plans for future or running some projections. Some of the pandemic related items are like, we're seeing a lot of like a contract cancellation payments, and there's a lost deposits, right? Some deposits that's not returnable, and inventory loss. And there could be abandoned business sites, where there could be some of the abandoned assets, and just making sure you're writing them off and recognizing the losses as much as you can. So that can be taken into consideration when you prepare your tax returns. Even though we're seeing a lot of the businesses are dealing with hardship, but we also see certain industries are actually blooming. And if you are actually expanding your business at this point, and consider purchase some of the fixed assets, that if I say, okay, I plan to purchase this bunch of equipment next year, maybe consider accelerating the purchase this year, and to take advantage of the accelerated depreciation, and which can help to bring down your taxable income. Also, that I want to bring up that a lot of the businesses also, could be purchasing a new building or building a new building. And in those cases, we highly recommend that a business consider a cost segregation study. What it does is, normally when we construct a building, and unless we do detailed analysis of let's say, okay, this much is for the windows, this much is for the floors. Unless we do super detailed analysis, normally the expenses for the construction are being lump summed into one number. And then when it comes to tax time, that one number, let's say it's a commercial building, and will be depreciated over 39 years, which is a long time. So if you do the detailed analysis, which is done through the cost segregation study, that you will be able to break down that lump sum number to multiple components. And some of them could be a 5-year asset, some of them could be a 7-year. In that way, then you can accelerate your depreciation. And also that there's 100% depreciation allowed for the bonus depreciation. So meaning that if I have something in the 5-year category, I may be able to take 100% deduction for that in the year that this building is placed in service. So there's a lot of companies out there do the cost seg study, and so it's very common practice. R&D credit, and we talked about it, but I do want to mention one thing about R&D is not just for tech companies. It actually applies to a lot of different industries, food and beverage, construction, and healthcare, and even cannabis. So even if you're not sure about your industry could qualify, I just encourage that you look into it, and because there might be good surprise out there. Retirement planning. I'm not an expert on the retirement plan, but I know there are 20+ type of retirement plans out there. So we always recommend that our business clients and talk with the retirement plan design specialist, and finding out a plan that's suitable for you, and really depending on where your goal is. And a lot of the plan are allowed, a very large portion of the contribution going to the business owners, and to help them to save for retirement, help them save for taxes. The state tax considerations. This one is getting more attention this year because of people moving around. We have staff moving to different states now, and a lot of companies do facing that as well. So one common question that we get is, okay, while my employee moved to Texas, and now am I subject to taxes, like rules, or while my employees move to Arizona, and what do I do, right? So it really depends on the situation. Some of the states have sent out specific, updates, guidance. Some of the states are been silent on that. So our general advice at this point is really looking at if your staff moving to a different state are temporary. Let's say they're just like, okay, I just want to go there for maybe during this pandemic for like a couple months and just out there, change the environment, and then we'll come back, right? Or they're really planning, they're moving their family, moving their kids' school and everything, and they're cutting their ties with California and they're moving out. So it depends on the situation that you do have to evaluate what impacts that move has on your business. And the employee will need to consider if the move have any impact on their personal level. On the business level, that there are two things that need to be considered. One is payroll tax. Do you need to register for payroll tax there? And the second is on the income tax side. Do you need to register for income tax, and would having a person physically in a certain state and now create certain nexus or connection for you with that state, and then do you need to suddenly start to comply with the income tax route in that particular state? Sometimes, depending on your industry, if you are selling certain, especially tangible goods, and to different states, and now with somebody physically in a particular state, would that generate any issues for you from sales tax purposes? So now we're going into the next session and about the capital gain planning. I understand that some of the audience are business owners, and you may have, planned some of mergers and acquisitions or business combinations and down the road. I'm not quite sure what stage you're in, but let's go through the rules, and hopefully that can provide you some ideas and for planning in the future. So one major capital gain planning strategy is the qualified small business stock, QSBS. This one has gaining a lot of recognitions, and because it's a great tool. First of all, let's talk about the qualifications. What type of shares qualify? It needs to be a domestic C corporation shares. Okay, and so sometimes our clients invest in foreign companies. Say, oh, can that qualify? I say, no, unfortunately, no. So it has to be a domestic C corporation. And the corporation needs to meet a asset requirement, meaning that they cannot have more than $50 million asset upon issuance of the stock. But that issuance is specific to you as a shareholder, meaning that if I acquired a C corporation return, the shares today, that I need to look at companies, the asset value as of today. Versus maybe Helen has, acquired share like a year ago, and then she will be looking at asset requirement like as of a year ago. So this is specific to you. Okay, and also the 80% of the assets of the corporation needs to be used in qualified tradable business. So it does exclude some of the industries from this planning opportunity. For example, the finance industries, the banks and personal services companies, let's say CPA firms or architecture firms and law firms and are not allowed, and hospitality, I believe, are not allowed in this either. So you do need to look at which industry you're in and to make sure that you qualify. And it needs to be original issuance. What that means is that either the company issue you the stock, and you cannot be purchasing that from any secondary market, right? And so essentially you got it when they issue the stock, and it could be from a stock option. And because we have a lot of the tech company clients, that they could be excising their stock, and that's considered original issuance when they excise their stock. It could be from a gift or inheritance. Let's say your parents invest in certain QSBS, and now they're gifting, and that's still considered original issuance. The shares need to be acquired after August 10th, 1993, and there's a 5-year holding requirement if you want to see the 100% benefit of this. Okay. What benefit we're looking at? It's great benefits. And so if depending on when you received it, and the small prints here showing that if you acquired between 93 and 2000 in February 2009, then there's 50% gain exclusion. And for the next batch is if you acquired it between February 2009 and September 2010, then it's 75%. If you acquired after September 27th, 2010, it's 100% again exclusion. And what can be excluded, and we're using two numbers, and one is a greater of a $10 million capital gain or 10 times of your cost basis. What does that mean? Okay, for example, if I invested in this company, I put in $1.5 million as my equity, and now I sold it for $16.5 million. So that's 10 times of my cost basis, right? 1.5 times 10 plus my original cost, and so I have a $15 million capital gain. The entire $15 million can be excluded from my income tax. Okay, so this is great, and it can really the 10 times is an annual exclusion. So meaning that if I sell this year a batch of stock, and that meeting the QSBS, and I'm selling another batch next year, that you could actually have more than the $10 million if you have done it right. Of course, there are certain things that we cannot control, like say the timing, right? Sometimes maybe a deal come in and that's the right timing, and if I don't do it, I may just lose the deal. So you can think too much about taxes at that point. But if you can, then maybe just think about the planning and timing on this, because you may be able to see some, again, good surprises out of this. What if now that I'm not able to hold a stock for 5 years? Because remember, if I hold it for 5 years, then I get the max benefit, right? But however, sometimes if the deal comes, I can't. I just simply cannot hold it for 5 years, and I can pass on the deal. What do I do? There's a rollover option. If you have owned the stock, hold the stock for over 6 months, now you're able to sell the stock and have the gain, but then you'll be able to defer the gain as long as you roll over that gain portion into another QSBS stock. Okay, so you don't have to pay tax right now. And state taxation need to be considered. As far as I know, most of the states do not comply with this rule, including California. So when you sell a QSBS stock, and if you live in California, you have that gain exclusion. You may not have to pay any federal tax, but yet you still have to pay California tax. So a lot of our clients have moved out this year, either to different states or to different countries, and California taxation is definitely one big concern at this point. Some of the planning opportunities here, and one is that it is possible for a partnership to reconstruct to be a C corporation and qualify for the QSBS. And so there are some legal issues here, and for converting a partnership to S Corp. So please consult with your attorneys on that. And but that's an impossibility. Okay, and also utilizing non-grantor trust. And I mentioned earlier that it needs to be original issuance, but you can acquire the shares by gifts or inheritance. So a lot of times that taxpayers could set up irrevocable non-grantor trusts and contribute or gift the shares of QSBS into the non-grantor trust. And the non-grantor trust will be considered a separate taxpayer for the QSBS limit. So essentially that if you're setting multiple non-grantor trusts, you could be getting multiple of that $10 million tax benefit. But the gifting part does involve gift tax or using your lifetime gift exemption. So there are some timing issue here, because if I'm gifting today and that's already at very high value, then I'm using up all my lifetime exemption. Then would that really is that really worth it? Because later on I sell it, and even though it's income tax savings, but it's still all part of my estate, right? And then now I don't have any lifetime exemption, gift exemption left. And what do I do with all this money? And how do I pass it on to the next generation? So there's a lot of different things, moving parts involved, and you need to think about. But it works great. For example, right now we have a case. The couple do have green card, but they are considering giving it up. They are still in a stage or time period that when they give up a green card, it will not be subject to the exit tax. So they are going to give up the green card, and they set up 2 non-grantor trusts for their kids, both offshore trusts. And the couple will get the $10 million gain exclusion, and each of the non-grantor trust will get a $10 million exemption as well. And yet, after they give up green card, their assets will not be subject to U.S. estate tax. So there's a lot of, really depends on your personal situation. You have to look into ways and see how we can utilize different planning strategies and to help you to achieve a good tax result. Okay. Some of the other capital gain planning strategies, and like if we cannot use the exclude the gain completely for the QSBS side. First thing is asset sale versus stock sale. And when a business owner and thinking of selling their businesses, and it could take in 2 different forms, right? One is I'm selling all the assets of my business, then I close down the business and wash our hands. That's it, right? Or I'm selling my stocks, and instead of itemizing my assets and putting a value on each of the assets, which way do I go? There's no clear-cut answers, so the answer is depends. So when your business have, like, say, a net operating loss from the past, and it's worth considering maybe doing an asset sale, right? Because when we do an asset sale, that any gain we're getting from the asset sale will be considered income of the company. So we got income from the asset sales, and we got the operating losses from the past operations. Now we're able to offset, and if the numbers work out right, then maybe we don't have to pay any taxes on the asset sale, and then we can distribute the proceeds or distribution, close down the company, doing the final distributions, and there may not be any taxes to the shareholders. And on the stock sale side, if it qualifies for QSBS, then great, right? And then that's one thing. And what if it does not qualify? Is there anything that then I will be subject to the capital gain tax? There are a couple of things that could can be associated with the stock sale. One is, even if it's a stock sale, it's possible to elect it to be an asset sale. So we're kind of changing that, but often the election is from the buyer side, and then it in turn impact the seller. So sometimes that if we wish is not be an asset sale, that as a seller of the business, you want to make sure that in the purchase agreement that you mentions or prevent the buyer to make any tax elections to treat it as asset sale. Because if they treat it as asset sale, it could bind you for treating it as an asset sale for tax purposes as well. So just keep that in mind. And what the other party doing for taxes sometimes have impact on how you treat it for your taxes as well. Okay. So now let's say, what if I really cannot get off the capital gain treatment and I have to recognize it? What do I do? There are some other planning opportunities here. And one is, what if that I set up a charitable remainder trust? I contribute my shares into the trust. And there are, I would say 3 benefits of this. And one thing is the charitable remainder trusts are not taxable entity. So meaning that the CRTs are not paying taxes themselves, and they receive the appreciated assets. The assets are sold after they're contributed into the trust, and gains will not be taxed immediately. Instead, the trust will distribute a portion, let's say a fixed percentage, let's say 5% each year, to the beneficiary, which is often the grantor. I contributed in, and I can also be a beneficiary of the trust. And I receive this distribution periodically, and it can be quarterly, it can be annually. We often see as annual distribution. That what I need to pay each year is I pay tax on what being distributed to me. And the rest of the money, the assets in the, from the sale of the original assets, stay in the CRT, and they can be invested any way you can. You can set up a child travel account, you can set up, a Merrill Lynch, whatever, and you can manage the investment of the remainder asset in the trust, and they grow tax-free. And so you get tax is an annual distribution. Upon the initial contribution, you also get a charitable deduction. It's not the dollar for dollar. Let's say I contribute $2 million in the trust, I get $2 million. That's not how it works. It looks like they look at, okay, this is the $2 million we're putting in now, and what's my life expectancy? What's the federal interest rate right now? There's a formula, then we're calculating, okay, given my life expectancy, what do I expect that the trust will leave something to the charity upon my death? And then we calculate a number. And normally the number is, it's a fractional percentage of what I donated, right? So it cannot be less than 10% of the current value because the government wants to make sure that, okay, at least as of today, as of the contribution date, they want to make sure there's something that could be left to the charity down the road. So we talked about, for this strategy, you get a donation upfront. It's a percentage of whatever the value you donated, and you got a gain deferral, and the money you get, even though you get tax off of a portion each year, but the rest of the money will grow tax-free in the trust. So it's a great planning opportunity, especially for people who also have the intention of, for working with the charities down the road. And another planning strategy that's came out in the last few years is pretty new, but being utilized by a lot of taxpayers nowadays, is the opportunity zone funds, the OZ funds. And what it allows is it allows capital gains from all types of assets being invested into this type of funds. In the past, like for example, for our real estate, right, we can do 1031 exchanges, but it does not allow you to exchange into anything else. You have to exchange from a real estate to a real estate. But in this case, if I sold a real estate property, I have some capital gains, but I do not want to invest in another property again, I can consider invest my gain portion into this opportunity zone fund. When I talk about gain portion, for example, if I sold a property where I sold a stock for $3 million, but I purchased it for $1 million, I only need to put in the $2 million or a portion of the $2 million into this opportunity zone fund. I don't have to put entire $3 million proceeds in this. I can put anything, any amount that I wish. And whatever I put in, the gain portion will be deferred. I don't have to pay tax on that portion that I put in, the OZ funds, and I can defer that payment till 2026. First of all, there's an income tax deferral. And the second is if I plan to hold this for long term, great. And if I can hold investment, OZ fund investment for 10 years, then anything, let's say I put in $2 million. Now the fund is doing really well. And in 10 years, now it grows to, let's say, $6 million now. The additional $4 million growth in the fund, if I dispose it, at the end of the 10 years, and that $4 million will be completely tax-free. So this can be a good, planning opportunity. If you have capital gains, you have to recognize, but you also wish to defer. But that being said, OZ fund is a new type of investment, so there are definitely investment risks associated with it. So please consider that and do your due diligence work and making sure that you consider all the risks before you invest. And this concludes the presentation. And I'm not sure if there's any Q&A, questions at this point.
Well, at this point, I don't really see any question from the audience, but if you guys have any questions, feel free to submit them now. A quick follow-up on the OZ fund, Jie. So if the investment is for business, the business has to be located in the opportunity zone.
Yes. I think the OZ fund, they're often what we see nowadays. There's the properties or businesses located in the opportunity zones, and on top of that, there's a fund that's investing in that. And we have not really seen taxpayers directly invest in a OZ business that's located in the zone. So that's not, we haven't seen that very, very often. So there's often another layer on top of it. So the taxpayer, like me, individual taxpayer, I don't need to worry about the direct investment. So yeah, there's a lot of compliance with this, and I know there's a lot of attorneys deal with the OZ zone, the OZ fund setup and the compliance.
Yeah. Okay.
Yeah, there are some local ones here in the Bay Area.
Yeah, so I think people, if you Google it, usually opportunity zone are the economic areas that the city or local governments wants to promote further development, right? So they're probably less developed than other areas. So they're encouraging the investment.
Yes, it's very interesting. Like in downtown, I'm in downtown San Jose, and there's a opportunity zone that in downtown San Jose. So you know that which areas they're considered that are underdeveloped at this point. So. Yeah.
Okay, it could be a topic, outside of your practice, but the zones are picked by the city or the state.
By the federal.
Oh, by the federal. Okay, interesting. Okay, I see. So I had one question. Majority of our clients are small business owners. A lot of times they face choice whether they want to draw salary out of the business or just draw dividend out of the business. So can you compare the two, the advantages, disadvantages?
Yeah, if there are a CCorp taxpayers, and I would say you probably want to draw it as a salary, because as an individual taxpayer, what's your highest tax rate now, right? And it's blended rate, but the highest, the marginal rate is 37%. Of course that plus your state. So depending on what's your combined income tax rate as an individual, that you look at, okay, how much I'm paying for this salary, right? Am I paying 37, it really depends on what's your blended rate. Let's say I'm paying like a 30% federal, and I'm paying 12.3% for state. So together I have a, like a 40% plus of tax, right? And versus as a dividends, that the corporation pay 21% on the profit of the corporation, and then as individual stockholder, that you get a dividend distribution, right? And let's say we do I don't know what numbers that we want to use. But essentially, if you're comparing same amount of money you're getting from the company, if it's paid as a dividend, then the company already paid 21% on certain income, right? That's our cost there. And the second is that you are, because the dividends is not deduction to the corporation, then you are paying on federal level, and on the most you'll be paying is the 23.8% federal tax, and then you have another state level tax. So the overall, whatever the corporation paid plus what you paid for federal and state, most likely will be higher than if it's treated as a salary, that the corporation level that they take that deduction, so they're not paying any taxes there, and then you're paying just the federal and state. So most likely that as a salary would generate a tax savings on the personal level. If it's a like S Corp, that's a pass-through. So there's really no concern about it's a distribution or it's a salary. However, that being said, and there are RS has been looking at the issues of S Corp shareholders not paying themselves enough. Because the issue is for all the income pass through from the S Corps, that those pass through income are not subject to the self-employment tax, the Social Security and Medicare tax. But if you're drawing salary, those are, right? So that's a lot of the S Corp shareholders pay themselves very minimal amount, so they bypass the self-employment tax portion. IRS has been auditing some of the cases, and because they say, okay, if you're a shareholder and you are the main management of the company, then you really should have paid yourself a higher salary. So that's if you're an S Corp shareholder, please take that into consideration when you're evaluating how much to pay as a salary to yourself. Okay.
Okay. We actually had a question come in. It says, could you please provide more info on the 20% pass-through through tax deduction?
So I think that's referring as the qualified business income deduction, and so that's another factor that you should consider. And when we call it pass-through, the 20% pass-through deduction is if you have a business like say S Corps or partnerships, and when you get the K1, and if the business is a qualified business, then you will be able to, generally speaking, of course, it's subject to certain limitations, to the business self and to your personal income level, that you, generally speaking, you will get 20% from the top and as a deduction, right? So you recognize 20% less income in this case. So that's another factor that should be considered when you selecting certain type of entities, because this is not available to the C corporations, and it's available to the S Corps and the LLCs. That's being taxed as a partnership, and available to partnerships, and available to, if you are a person, you're not incorporated anything, you just do it on your own, you have a Schedule C, that's available to those people as well. So that should be considered. I do want to bring up one scenario for you to consider. Let's say I have a business right now. I could set up as a partnership, or I could set up as a C Corp, right? And so when I compare the two, okay, on the partnership side, I will get the 20% deductions, and so I could be paying less income tax, right? I feel like I could be paying less income tax on a general basis. However, I'm planning to sell the business in in just a few years, and my business could qualify for the QSBS treatment. And so now it makes it interesting is now you're not only comparing what on the regular, every year, what do I pay tax on the entity level? What do I pay tax on individual level? You're also comparing the tax, projections upon exit. So it's really a more complete picture. And I do suggest that if you are considering exit the business in a few years and it's a newer establishment, please take a look into the comparison of different entity type, what it could result in as a combined tax result of your annual operations and as your upon exit, and see where it leads to and make decision, based on that. Okay.
All right, folks, we've got about 3 minutes left for our presentation. If you have any last minute questions you want to get in, now is the time. Otherwise, I would really like to thank Ji Zhu for her fantastic presentation and her time. Thank you so much for that. If you did attend the webinar today, you will receive a copy of this video, a link to the video that I should say that you can rewatch it or download, and also a copy of the presentation as well. So with that, we've got a couple more minutes for questions.
Thank you very much, Jia. Yeah, it's very informational and very practical. I mean, yeah, all the information is very practical.
Well, thank you.
So for business owners who want to exit or sell the business, how early do you recommend them start looking at tax planning? 1 year, 2 years, or?
Oh, it could be much longer.
Okay.
We do recommend as soon as you have that intention to sell your business, that you should start looking into it, and it does not really limit you to the 1 year, 2 year. And some of our clients, the planning could involve several years, for 5 years, right? Because depending on what they're trying to sell and what's involved, and it's not just your tax considerations. And when you sell your businesses, and you probably have to look at the multiple things, right? One is, what's my business current value, and is there a way that I can strategically maybe restructure, or maybe restructure my not just the corporate structure, but my operations, that we can bring the value up for the ultimate exit. And so there are multiple things, and so we do recommend business owners to start looking into it. And the tax is only part of it, and when it comes to M&A, there are so many other things to consider.
Yes, that's true. Well, I guess we don't have any more questions, so we can probably conclude here. Thank you very much, Jia. Yeah, thank you for your time and effort.
Well, thank you, and happy holidays.
Happy holidays.
Yeah, happy holidays.
Bye-bye.
Take care.